introductions first around the room, and then we'll come back with some of our meeting guidelines and then get right into our speakers if we could. So I will start with Cindy.
Cindy Dozier, Hinsdale County Club 20 Chair-elect.
Michael Murphy, Hinsdale County.
John Peters, Uray County.
J. Paul Brown, LaPlata County.
Wayne Jeffries, Supply County.
Rachel Richards, Picken County Secretary.
Christian Reese, Executive Director of Club 20.
Nicola Callie with Club 20 staff.
Jordan Kelson, Club 20 staff.
Ricky Citarelli, retired attorney from Gunnison.
Aaron Linky, Grant County Commissioner.
Eric Rulis, Mesa County, Club 20.
Joe Meyer, District Manager for BLM for Southwest Colorado. Bruce Dowd, Mesa County.
Chris Holstrom, San Miguel County Commissioner.
Alicia Austin Johnson, Associate District Manager for Northwest Colorado, BLM.
Don Cook, Moffett County Commissioner.
Jeff Comstock on the Executive Board of Club 20.
All righty, we'll start over on this side with Brian.
Brian Leinhardt, Congressman Tipton's office.
Kimberly Lindsay, Club 20 staff.
Eric Carlson from Mesa County.
Nancy Shaw, Mesa County. Betty James, Montezuma County.
Eric James, Montezuma County.
Alan Lemons, Wells Fargo Bank. Rod Sharp, Wells Fargo Bank.
Joanne Snyder, San Miguel County.
Terry Lambert, San Miguel.
Mike Gusar, Montrose Forest Products.
Scott Armitrout, Forest Supervisor, Grand Mesa and Capagre Gunnison National Forest.
Doris Colby, Mesa County.
Tim Huff, Mesa County.
Kimberly Bullen, City of Rifle.
All righty, thank you very much, and thank you everybody for using the mics. That's one of the things that we want to be sure that we're doing today. Instead of making our staff take notes feverishly, we're going to be recording the meeting, so if everyone could be sure to speak into the mics better than I did to start with. So if we could do that. Just real quickly, some of our meeting guidelines we kind of ran down through. We ask that only the active Club 20 members be seated at the table for the discussions, but please know anybody and everybody is welcome to be a part of the conversation. So if you're sitting behind me and you want to say something, don't throw anything too big, but don't hesitate to speak up so that I can turn around and take note that you would like to participate. And let's see, we talked about our microphones. Though, do we have anybody joining us on the phone?
Yes, you have Grant Colvin of the U.S. Senate Agriculture Committee.
Great, thanks, Grant. Appreciate you joining us. Anyone else? All right, so Grant, anytime if, I know that you're going to be helping to present here in a little bit, but if there's any other time that you want to speak up, well, don't hesitate to jump in there. Okay?
Okay, thank you.
According to the bylaws, all current Club 20 members in attendance may vote on matters of the committee or subcommittee business, but please only vote if you are a current Club 20 member. And of course, if you wish to become a Club 20 member, if you have any questions, Kimberly, where'd you go? Was passing the mic around.
I am right here.
Kimberly will be glad to visit with you, and I don't see Ray.
He's on
Did
his
you
way.
leave Ray home?
I left him at the gas station.
And last but certainly not least, we want to be sure to thank you to our sponsors. So M4 Ranch Group, thank you very much for being our venue and lunch sponsor. And the committee sponsor is Southwest Energy and Home Loan Investments. So thank you very much to those sponsors. If we could ask for a round of applause for those. All righty, now if I can find my agenda. paper has never been my friend, sorry. Okay. What we want to, oh, wait a minute, I'm sorry. No, I did not. I have no. Don't do that right now. Okay, thank you. All right, so we want to start off today with the conversation about trends and access to capital. And so we've asked Rod Sharp, who is the Senior Ag Industry Specialist for Wells Fargo here in Grand Junction. Many of you probably know Rod from his many years with CSU Extension and so forth. So appreciated Rod coming to join us here. We've tried several times to get him, and he keeps telling everybody I tried to keep him out, but that's not true. We tried to get him here. He's had a very busy schedule. So thank you, Rod. Appreciate it, and we'll turn it over to you.
Okay, I'd also am happy to tell you that my boss out of Brighton, Colorado, is here today, and so I invited him to cover for all my mistakes that I said here earlier. So anyway, I appreciate the opportunity to be here, and again, I started in ag lending about 3 years ago, a little over 3 years ago, and I've really enjoyed it. I've always had a passion for trying to help agriculture, and I thought maybe kind of the last part of my career, I could probably do more good in agriculture by helping finance some of the agricultural businesses we have, and especially young farmers and ranchers that are trying to get into agriculture. I was asked to talk a little bit about trends and access to capital, and then I talked to Robbie LeValley, which I worked with for several years at Colorado State University, and she said that I needed to specifically talk about Dodd-Frank again, about the regulation and maybe how it impacts agricultural and access to capital for agriculture. But I think it's important that we cover a little bit about kind of what we look at or what kind of process that we go through at Wells Fargo and other banks to determine whether we want to give access to capital to an agricultural business. But anyway, I want to just kind of give a little bit of background. Many people don't think of Wells Fargo as a major player in agriculture, but actually, if you look at all the banks that do agricultural lending, Wells Fargo is by far the leading agricultural business lender in the country. And a lot of this is of course in the Corn Belt and throughout the whole United States. But in Colorado, we have a new program that was started about 5 years ago. And Alan headed up that, and we have a really good program here that we think is going to be very useful for agriculture here in Colorado. I guess you could say, I had a couple of bullet points here at the bottom, that a few large banks hold a large portion of the total agricultural lending portfolio, and a few large banks are listed up above there. But also there are thousands of smaller community banks that also hold a large segment, and we're a little bit different, and we're going to talk, especially when we get to the regulation, and maybe how large banks are a little bit different than smaller banks. Okay, so why is access to capital important in agriculture? And most of the people in here are probably familiar with agriculture and understand why it's important, but I thought might kind of just go over it. In agriculture, we typically have sales probably once or twice a year or something like that. And so it takes capital to actually produce a crop or produce a livestock enterprise. And so in agriculture, we have demand for lines of credit to do operating expenses throughout the year, and then hopefully pay those lines of credit down at the end of the year when you do sell your crops or your livestock products. We also have a demand for capital for purchasing livestock, purchasing equipment, breeding livestock, and these are longer term loans to better match the life expectancy of those assets. And then also we have longer term loans for real estate and more long-term assets. So what kind of required information do we require from an agricultural producer coming in to get a loan? I think most banks or all banks require tax returns, and this is kind of helps us document sales and expenses that people have. We also require balance sheet information, and from this we can determine the financial strength and weaknesses of a business, and also proof of collateral. And then some of the larger loans or some different loans, we look at cash flow projections, and it seems like as agricultural economy here is down, we probably require the cash flow projections more than we have even on smaller operations. But anyway, this gives us an estimate of production and market prices that they expect to sell during the current year, and also expected expenses. When we, at Wells Fargo here, we look primarily at three different things when we're looking at an agricultural loan. We're looking at the debt service coverage. This is kind of a new, I think back in the 80s, banks were more concerned with collateral to cover a loan, and now we also have concern about that, are they able to pay back the loan if we do a loan. And so this is an indicator of how strong they are in their capability of paying back a loan. So this just gives you kind of a rough estimate of what kind of calculation you do to calculate a debt service coverage. So you start off with kind of the net farm income, add back in depreciation and interest on term debt, and then any personal income, you'd add that into non-farm income, and then subtract out family living. So in this example, we had I had a debt repayment capacity of $110,000. And if they had like debt payments of $50,000, that would be an indicator of a debt service coverage of 2.2. And we're looking for a debt service coverage of 1.25. So if we had 1.25, that means that for every dollar that they're going to owe in debt payments, they have about $1.25 to cover that. So that gives us an indication about cash flow if they're able to cover those type of expenses. I know you're not going to be able to read any of this in detail, but it kind of gives you an indication of how much detail we actually can go through with some producers. And if you look at the top left corner, that's the projected cash flow summary. We have a projected change in working capital right below that, projected income statement, projected earned net worth change, which is important. Are they growing, or are they generating increase in profitability over time? And then that debt service coverage is up on the top right-hand corner, I think, if I have it. So in this example, we said we wanted it at 1.25 or greater. This producer actually had a 7.11, which indicates that he's very strong debt service coverage. And then we have all of our financial standards here of measures the strength and weaknesses of that operation from the balance sheet information. And then also down here we have kind of a shock analysis that determine if we had a 10% decrease in revenues or a 10% increase in expenses, or if interest rates went up, how would this debt service coverage change with that? So it gives us a real indication of what this operation looks like. The second thing we look at again is collateral, because if something happened, if default on a loan, we need to have some collateral to help maybe get back the payment on that loan. One of the criteria we have at Wells Fargo is typically we have a 70% loan to value, so we won't the maximum amount that will loan on a piece of equipment or a piece of property is up to 70%. And some other banks may have some different credit policies on that, but that's kind of what we use at Wells Fargo. We also have a relationship with the Small Business Administration, of which we can do some higher loan to value stuff to help with maybe some newer producers or some different operators. The third thing we look at is we review their credit history through a credit bureau report. And basically we use this as kind of determine kind of what are their behavioral factors, or do they pay their bills on time, that kind of thing. So it's just more of a behavioral score. And of course there's other things that we look at are important when we do an agricultural loan. Experience in the industry, are they new to the industry? Do they have a learning curve? Those kind of things, or do they have experience in that industry and understand what's going on with markets and risk and everything? Quality of records and management skills are real important. We'd like to identify and try to identify good managers and good records. Another important thing is succession plans. A lot of times, if somebody becomes disabled, or if they have a death of the ownership, what kind of succession plan does this operation have? Will that business continue in kind of a seamless manner? And then also we look at the business and industry analysis on its own. And are there competitive advantages that this producer have? are there market niches that they have over some others, or what are the risks that this business or this industry has that maybe we need to look at? Okay, so access to capital. Not all borrowers are created equal. So if we have a strong borrower that met that criteria we were talking about earlier, I don't think they're going to have any problem with accessing capital in any type of from any bank in town. You know, the strong borrowers is what all of us are looking for. We're probably all trying to recruit. Okay. And typically these will have, because of the competition we're trying to get with other lenders, we'll probably try to offer as low interest rates as we can to bring them into our portfolio. Some of the marginal borrowers that may not meet those criteria very well, they're probably going to have fewer options for borrowing, and a lot of this depends on the bank's credit policy. Some bank credit policies are a little more lenient. We're a fairly conservative bank. We don't want to get the lender in trouble, and we don't want to get the bank in trouble, and so we're pretty conservative. But some other banks may have some credit policies that may make it easier to get a loan on some of these criteria. Higher risk to the bank typically mean a little bit higher interest rates, so they kind of relate the risk to the cost that it might be to get a loan. Another one that's kind of passionate to me is the new and beginning farmers, and these are the ones that are really tough to probably get loans, especially if they don't have a lot of equity or their liquidity issues that they have. And the good thing about this is they have some special programs. The Colorado Department of Agriculture, USDA, and others have some grant programs and some special programs to help them at times. So a lot of the new and beginning farmers may look at some of these special programs to help them get started. Okay, some recent trends. Again, not all agriculture. When you talk about agriculture, you guys know it's a very diverse group of industries. And everything isn't the same every year. So dairies and pork have been classified as a higher risk industry and a little bit more difficult to access funds at times. But if you have a strong borrower and they have these crops or commodities, then they'll still be able to get access to funds. Grains and hay producers, I think in recent years, I think most people in agriculture realize that these guys have suffered probably 2 or 3 years in a row here, maybe even 4 years in a row on some of them. And these are the ones that are probably year to year that we're noticing some downgrades in their credits and how strong they are on those policies that I looked at earlier. And so they may go onto a watch list or a downgrade and try to work them through this downturn in their commodity markets. Feeder cattle, again, we're probably looking at feeder cattle a little closer. Last year was a very tough year for feeder cattle when they're buying feeder cattle at real high prices and try to sell them back after they put some gain on them. And so we've been required to do a little more closer monitoring of these with borrowing base and maybe looking at requiring hedging or some kind of a market plan for those cattle. Cow-calf producers, again, I think this is the biggest range of that I see in a commodity where we have some very good producers that are very low cost producers, very efficient producers, and they're making money at current prices. And then we have some that are probably losing a lot of money at their current prices just because of their efficiency and cost of production. Fruit, again, because of the perishable part of the fruit, we try to make sure they have a good marketing plan for their fruit if they're going to get a loan, because it's perishable, it's not going to last. They can't put it in a storage bin and keep it till next year. And so market plans are very important, and also some risk mitigation related to some of the frost issues that we might have in Colorado here. And then sheep and lambs had a pretty nice couple of years, and so probably so basically what I'm trying to say is that every part of agriculture is a little bit different, and we probably look at each of them a little bit differently. Okay, now maybe the real reason you probably asked me to come here today is I wanted to look at a little bit about maybe what has the impact of Dodd-Frank had on agricultural lending. Well, if you remember back in 2010, I think is when this was enacted, and that was kind of following the financial disaster that we had at that time. The purpose was really to promote financial stability in the United States. And in general, there was a lot of financial institutions that were doing some high-risk stuff that was kind of putting everybody at risk. And so what this law, or these series of laws, I think there were several, I don't remember how many titles, but several titles for different aspects of the financial institution that try to reduce risk and increase transparency and promote market integrity. So what has been the impact on maybe agricultural lending or business lending? Well, I think most banks have had to hire probably FTEs to specifically assure that we're meeting compliance related to these laws. And so there's some costs associated with that. There are some additional resources, because even me that really doesn't deal with compliance, I spend a lot of time and effort to make sure we are compliant and meet the laws that our compliance people are asking for. So there's quite a bit of cost associated with having additional regulation. There's a lot of, if you look at the literatures, there's a lot of, at least opinion that there's a larger impact of Dodd-Frank on smaller banks over larger banks like Wells Fargo. And one of the reasons is because we have a lot of resources that maybe a smaller bank don't. We may have already had a pretty good sized compliant group within our bank. And then even if you think of a small bank that has to increase their compliant group from 1 person to 2 or 2 to 3 or whatever, then that relative cost, because of the efficiencies that maybe Wells Fargo has from economies of scale or a larger bank, we may be able to cover the cost of those things a little bit easier. One of the things that I've noticed in my short time in ag lending has been the additional scrutiny and loan application and analysis. There's a lot of duplication of forms, and it may be just Wells Fargo processes that require this because they want to make sure we do meet the compliance requirements. But for example, just documenting ownership of a business, percent ownership of a business, we'll maybe have 2 different or 3 different forms proving the same thing. One's kind of documenting the other, make sure we did the other. So we do have a lot of duplication, it seems like, of forms and information collected. I think a lot of the borrowers are a little frustrated with how much information we try to collect and verifying names on driver's license and those kind of things, but that's all related to making sure we have exactly the right information. We have more eyes reviewing the information all the way from application. We have a lot of eyes looking at the application, make sure everything's correct, we have all the information correct. And also more eyes looking at the approval process. Make sure we are following some of the regulations related to this. Make sure, an example of this is I have a borrower that typically borrows an operating line of $600,000, and because they've only been using $400,000 every year, that we've actually reduced the amount of that line down to $500,000, and that's all related to kind of regulation. If the regulators come in and look at us and they say, well, how come you're loaning this guy $600 every year and he's only using $300? And so we're making adjustments to that in order to follow the regulations. And again, I guess, we have those criteria at the first. The loan decisions are based on quantitative measurements as opposed to what I call kind of soft information. I've worked with farmers and ranchers from my Colorado State University position for a long time, and it's easy for me to recognize fairly quickly a good manager and a poor manager. But some of that stuff, there's some people I know that no matter what you would do or what kind of loan you'd provide them, they'd pay it back. But because we're required to make sure we have these quantitative measures, we're not able to maybe do a loan that we could probably do previously. Maybe when Alan first started 30 years ago, they could probably base a loan more on just the characteristic of the borrower versus the quantitative measures that we have to measure here. I thought I might briefly talk about this small bank thing. There's quite a bit of literature out there related to how is Dodd-Frank's impacting small banks compared to larger banks, and this one I thought was pretty good because they did a survey of a lot of the small banks around, and if you look at this, it's kind of interesting that they asked the question, what is the change in annual compliance costs since Dodd-Frank? And you look look here, there was like 83% basically said that it increased more than 5%. There's another 8% here that was basically increased less than 5%. 3.2 that said no change. And then there was about 5.8%, I guess, that said actually their cost of compliance decreased due to Dodd-Frank, which was kind of interesting. So that does kind of support the thing that it does increase the costs associated with the regulation. Okay, and then they asked him, how does Dodd-Frank compare to the Bank Secrecy Act, which was also a federal regulation that they had to follow? And you see here, oh, sorry about that. You can see here that this here, 65.6, you can barely read it here, was they said was significantly more burdensome. There was 16.4% as burdensome. There was this other part here was slightly more, but there was a few that said it was actually less burdensome due to the Dodd-Frank. What are your changes in customer fees? Well, the fees actually, if you look at here, 40% remain basically the same. This 24% is actually decreased by more than 5%. These here, it's kind of hard to tell the things, but these are actually increases by either less than 5% or remain about the same. So, changes in return on equity. So how does profitability at the bank change since Dodd-Frank? And you can see that basically the orange side over here, they said that about half of them said it decreased either slightly or significantly, and the others either profitability is increased or no change. Okay, so what was the impact of Dodd-Frank on products and services offered? They wanted to kind of see what are these smaller banks offering less services, offering less products, and as you might have guessed, the residential mortgages and home equity lines of credit and those kind of things actually were the biggest impact on these due to Dodd-Frank. If we looked up here at agricultural lending on these small banks, they've anticipate discontinuing some things, but they haven't done anything yet. So that the impact has been fairly small on agricultural lending from these smaller banks. And then where does the compliance, who's responsible for compliance? On these small banks, they indicated that about 94% is responsible in-house compliance personnel, but they're also using a lot of external consultants, legal counsel, and compliance personnel. So kind of, I guess in a summary, I think there are possibly higher costs to the borrower due to compliance costs that they're going to pass on, probably rates and fees perhaps, but that's not really been proven on the survey. And also higher prices for basic products and services perhaps. Another impact may be banks trimming product lines, so there may be less products within the bank. Small bank mergers, if there's more efficiencies of scale of larger banks, some of these smaller banks may merge together to take advantage of that efficiency. And then I think the biggest impact that I can see at our level is this additional scrutiny as far as more forms and paperwork and documentation to make sure we're doing everything correctly, but also probably a little bit reduced risk appetite. We're not going to take as big a risk because of the regulations because some people come back on us and say, why would you do this based on the criteria that we have to work through. So anyway, I guess I have time for a few questions, and maybe Alan can help me if we have any. So
Go ahead, Rachel.
Thank you. Thank you for the presentation, and just kind of on that last slide, do you think another impact has been the potential of avoiding the type of financial crisis and meltdown we had years ago?
Well, I think the law will help us prevent us from doing the financial institutions, I'm not saying us, the financial institutions to do the risky things, and primarily the biggest risk things that I can see were like with swaps and derivatives and things like that, and so like within our program, I can mention swap as a product that the bank offers, but I can't talk about it because I'm not trained in swaps and those kind of things. So there will be a lot of
Your
impact.
potential more security.
Alan, you want to comment?
My name's Alan Lemons, just so you know who's talking since it's recorded. One of the things is to answer your question, because it was about reduced risk. If you look at what caused most of the crisis, and you look at that last, or second to last slide, I think, most of all that was in consumer products, primarily in mortgages. And when you looked at it, a lot of those groups that were lending those mortgages and where the highest risk and loss were actually not in whether large or small banks. A lot of them were third-party originators, okay? And so that controlled a lot of that. The biggest impact, I think, as far as banks are concerned, is, and I'll go use his example of derivatives and stuff. In agriculture, probably created the biggest issue because it doesn't differentiate between speculation and hedging. And a lot of small agricultural, all size, use hedges to protect their position on their cash, versus the market on commodity prices, especially in a falling market. They can lock in a price on the thing. Well, it changed it for like a bank of our size, that the customer has to show $10 million in liquidity to be able to take advantage of one of those. Well, that takes away a product that a customer had. Now, they can get it from somebody else, but not from me, which is, that's neither here nor there. They always had that option, but it changes that a little bit. Most of the rules, a lot of the rules are affect on Dodd-Frank, affect the mortgage side and that side, and it changed that risk appetite. But what you see, and it backs in there, and it's not necessarily a rule, it's not really an action, but what happens is, it's like anything. I can tell my son to do something, and the way he interprets it and does something else is, he's like, I'm not going to get in trouble with Dad again, so therefore I'm not going to do that, right? And a lot of banks, we react that way. And that creates some of the restriction in capital. The other thing is, and it's not just Dodd-Frank, because when they were asking me about regulations, all regulations, has created pressure on American agriculture in the fact whether it be environmental and all these other regs that we have on agriculture, has the effect of increasing our cost of operation in the United States in agriculture, which our competitors do not face. Chemical companies, and you can pick a name, whatever one you want, did not quit producing some of these chemicals. They send them to Mexico, they send them to South America, they send them all over the world, and those companies use those countries use those. Their cost of production is less than ours, and then they send the products back here for the same price we get at our cost of operation, which puts additional pressure on the earnings profitability of our farmers and ranchers in the United States, which then in turn restricts their capital access because of those things. Now, overall, the rules as far as lending and all that, I would say for the most part, the answer to the question is, when you look at some of the surveys, did it say we increased our thing from 70 to 75% as far as what we'd lend on collateral? No, the rule is always there, but the truth is the bank said, that's always been our rule. We're going to adhere more to the rule now, because when a regulator comes in and says, why did you give this loan to Bobby Sue and you didn't give it to Billy Bob? And so consequently, I may have a whole list of reasons, all the soft things, but what's happen is it becomes more quantitative. Now, that creates pressures on banks of all sizes, because there's some people out there, contrary to popular belief, that can show me a lot of stuff on a financial statement that's not really true. And it says I should lend to them, and I turn them down anyway. I gotta be able to defend that. But that's where you get all these extra lines and all these extra reviews and all these things.
Thank you.
Yeah, go ahead.
Okay, Rod, the chart you should put up with Wells leading in ag lending, what portion of your portfolio is ag lending? As for Wells Fargo as a whole, what percentage is actually ag lending in Wells Fargo?
I don't know. Overall, Now, you're talking about Wells Fargo in general or my portfolio?
No, Wells
specific?
Fargo in general.
I think about 10–15%. It depends on what it is, because there's agribusinesses that are in there that are, I don't know that exact number. I know in Colorado, we're about 10% of all the lending in the state. What happened, and to Rod's point earlier, what we did is we consolidated all the ag lenders in the state underneath me. We've had them, they've just been scattered out. In the Midwest, it's a higher percentage than it is in other state areas. I mean, like in some states, it's like 50% of their portfolio, like Iowa and some of those places. So kind of depends situationally, but and the great thing is it's kind of commensurate with the population of the United States. There's only like 1% of the population's in ag, right? So, you know, we're above that percentage-wise.
There was a question over here.
One of the questions I have is, do you see more movement for real estate investment trusts to move into agriculture here in the western slope as a result of all of this, you know, sort of regulatory environment that's another access to capital? I know I've seen that in the east in certainly the forest products industry where I work, but have you seen any of those private equity firms? I know some my timber investment companies have invested in Colorado, not the West Slope, in ranches.
Yeah.
As a trend.
Yeah, I have seen that, and I think we'll probably see more of it over time, so.
Yep.
Could you two sit by
This
each
is,
other?
I could. No, you know, people generally don't want to sit next to me. But to answer part of your question, one of the things we saw a big investment of those kind of groups in the Midwest. Now with the grain prices falling to like 50% of what they were 3 years ago, and that ground there, you had air grade ground selling for $20,000–$30,000 an acre, and per acre rents of $10,000 an acre. Obviously, that won't even pay 200 bushel of corn will not pay that rent today, right? So consequently, what you're seeing is some of those guys, it's kind of chilled some of them because they've lost a lot of their investment. It's going to be situational. I think it depends on what that ground is and what its alternative uses are. You know, you're in the middle of Iowa, middle of Kansas, and really about the only thing you can use that for is wheat or soybeans or whatever. You're not going to see that. You got recreational use and other developmental uses. We're seeing more opportunities for that in some of those communities there. And they come in and they have a different return schedule than a bank does. And so, and to be honest with you, they don't have the same rules. They're not even close to the same rules. And so, as far as protecting the customer, i.e. the farmer rancher, they do not have the same protections that they would have under borrowing from a bank or financial institution.
Okay, Ricky.
I have a question more on do you notice any change in what agriculture is? I'm not really close to it, but it seems to me that there's a lot more people who are trying to get income from agricultural pursuits that I would call like hobby farmers rather than really serious agricultural producers. Do you see that, or am I just getting a bad picture?
Yeah, what I've seen over the years is that the part that is decreasing is kind of the middle-sized farm. So either you have these middle-sized farms combining into very larger farms, or you have these middle-sized farms splitting up into smaller, more of the hobby part-time farmers that you're talking about, I think. So I think the part that's decreased over time is probably this middle-sized farm, more of the family farm type of a thing that is decreasing slowly over time, I think. So.
I got
The ag tax exemption is.
part of the conditioning program. Running back and forth. To answer your question in a more specific manner, what we've seen with the decrease in commodity prices is even the farms that they always worked on that farm and it historically would support a family unit. What's happened is, because of the decrease in commodity prices, a lot of these people have had to have one or two members of that farm family go to town. Now, they're still farming the same number of acres, they're still haying the same amount of ground, but what happens is that doesn't generate enough income in the increased cost of living and all the things we're seeing today, that they have to get more non-farm income to be able to be a viable operation. So people say, well, it's a family farm because Alan's working in town now. He works for a bank. He just doesn't, he has cows in Laramie, but, he's really a banker, not a rancher anymore. Well, used to 300, 500 head unit would support 2 or 3 families. Well, today that's like 1, right? And so, did we give up on doing that stuff? No, we didn't do that. But, you say I'm just using you as an example, not picking on you, is that this is a hobby farm. Well, it's just the difference in the size and economics of scale. And the cost of growing is so much higher, i.e. the ground costs and all the other compliance costs to do that a lot of these operations are not growing. They're just staying the same, but they're having to have more people work off for them.
Okay, one more question, go ahead.
Are your banks willing to look into creative solutions to keep people on the ranch, such as ag tourism kind of funding, where the ranch families are still able to do what they're doing, but taking in like an Airbnb ranch kind of income where they would need some financing to expand that part of the business? Are banks looking into doing that?
When we look at the operation, we look at all our sources of income from the ranch, whether it's growing the commodity or hunting income or recreational income or tourism. All those sources of income or potential sources of income are looked at that. And then when they're looking at different, for instance, this afternoon I'm meeting with one of my customers and he's actually thinking about transitioning into something. So he just wants to kind of pick my brain what I think about the potential of this new endeavor. And so we're always looking at opportunities to try to strengthen that financial picture of that operation, whether using alternative income or alternative sources of income.
All right, well, thank you very much, Rob, and I'll appreciate that very much. All right, just trying to keep us on schedule for once, as this chair has not always been great at doing that, so we'll work on that today. So thanks again, appreciate that, good information. Western slope agriculture has its own challenges sometimes, some much like the rest of the state and the country, but others too. I think one of the things that we have to watch is the value of our land, just for the scenic beauty, and that piece of it really adds to our value of land, but certainly doesn't help the cash flow necessarily. So if we could then move into our farm bill update, and I see Noah did come in, and I believe that we've got Grant on the phone, and we have Julie, is that right? Okay.
Yeah, we've got a whole handful of people.
All right, well, I'm gonna let you introduce everybody then, so come on up and I'll move, you can borrow the mic here, and we'll turn it over to you guys, so thank you.
Oh, no, you're not.
Good morning, everyone. I'm sorry so many of you are sitting behind me. I'm Noah Koerper from Senator Bennett's office, for the handful of you I don't know. I'm going to start with this. We're going to do most of this, I think, over the phone with some staff that we have on the phone that couldn't make the trip out. But first, I want to start by introducing a couple of new folks from our staff. I want to start with Julie Duvall, who's sitting over here. Julie, as many of you knew, Sarah Hughes in our office. Julie has taken over Sarah's role. She comes to us from a really diverse background and she's got roots here on the West Slope. So we're really lucky to have her. She's been with us pretty much since the new year. And then on the phone, we also have Lee Swenson. Lee, are you there?
Yes, I am.
All right. So Lee comes to us actually from the USDA, where he was the executive director of the Farm Service Agency here in Colorado. Lee is here specifically to work on agricultural issues with us. I can say I've been with Michael's team for a while, and I don't think we've ever had somebody who knew knew the ins and outs of ag from the on-the-ground level and the real working level at the depth that Lee does. So he's going to be working with us over the next year specifically on the new Farm Bill. And that's mainly, I think, Callie, what you have us on here to talk about is the new Farm Bill. So basically, as many of you know, my boss, Michael Bennett's on the Agriculture Committee. He worked a lot on the 2014 Farm Bill. And we worked with quite a few of you. We held a listening tour where he traveled to something like 32 different communities around the state and heard from folks about what was working, what wasn't working, what we needed to update. We followed that up with actually a tour after the Farm Bill got completed to see how it was going and see how implementation was going and try and use that to guide USDA to further and improve the implementation of the Farm Bill. And now we're coming around the corner and looking at another one that needs to get written in the next year. So we are hoping to hold a very similar process, have a lot of folks, including staff, out doing listening tours, and making sure that our work on the Farm Bill is going to be rooted in actual communities here in Colorado. Lee, who's on the phone, is going to be a really, really critical part of that, and he's already working to schedule a ton of days out in the state, and we're going to have him out in Club 20 communities as well. But given that your ag committee meeting is right now, we wanted to make sure that we were doing some listening of all you while you're here in this room, and we've also got a really critical partner for us on this, Grant Colvin, who worked in our office for a number of years, and I think with many of you, and is now on the Agriculture Committee in the Senate. Grant, you're there, right?
Absolutely.
All right, great. So you've got four of us, two of us here in the room, two of us on the phone. I think that ought to be enough. And the way that we like to do this is to start with, Grant is going to give you guys a little bit of an overview of the Farm Bill and what we're looking at, what kind of a timeline we're expecting this year. And then, I expect that'll be about 15 minutes. And then after that, we're just going to open it up to all of you because, we mean it when we say this is a listening session. We want this to start by hearing what the priorities are here on the ground. And Callie, I know you've got an hour on the agenda for this. I think whether or not this is an hour is up to all of you. We don't have to take that long, but if folks have that much that we all need to hear, and we'll be taking notes and using this to kind of help kick things off when we're doing this, the listening tours on the West Slope.
Excellent.
So, yeah. So, Grant, I'm going to turn it over to you if you're ready.
Yeah. Thank you, Noah, and thank you, Robbie and Callie and folks who have been so generous with their time in council over the years. I think it's been a great partnership. So I'll go a little into some specifics on the Farm Bill, the process you can expect, and perhaps a little bit of context around it. Farm Bill is also a bit of a state of mind around here in addition to being a piece of legislation. So hopefully this is helpful to get everyone in sort of the right mindset. Obviously, this is a big transition year. We have a new Congress and several new members of the Senate Agriculture Committee. Just for folks who follow this kind of stuff, one of those guys is a Westerner, which I think is good. I've always thought of myself, and I've thought of Senator Bennett as a Western insurgent into Southern and Midwestern agriculture interests, which often dominate a lot of the policy conversation around here. And so Senator Daines of Montana is joining the committee. He's a Republican. We have Luther Strange, who's just appointed in place of Jeff Sessions, who's now Attorney General. He's from Alabama. And then Chris Van Hollen, he's on the Democratic side. He's from Maryland. And so we'll be looking forward to working with all those guys, and it's something that we're going to should be a fun addition to the committee. Obviously, there's a new administration. We are hopefully have all the paperwork now submitted by Governor Perdue, who is from Georgia, or governor there, and he is who the president has nominated to be Secretary of Agriculture. This has been a bit of a long process, where a lot of you folks have probably seen acrimony over some of the cabinet nominees, and for various reasons. Agriculture tends to be a place where we have regional differences rather than partisan differences, and I think you'll find that Governor Perdue has quite broad support from within agriculture, and certainly my boss, Senator Stabenow of Michigan, who's a ranking member of the Senate Agriculture Committee, we had a very positive conversation with him as well. So we look forward to moving that along once the White House kind of, I guess, crosses all its T's and dots its I's and gets that paperwork in, and we have all the financial information we need on him. We will proceed with a hearing on that. You can also expect that there will be around 20 additional nominees that must be Senate confirmed at the Department of Agriculture. In some instances, those are actually going to be some of the more useful and substantive conversations we will have early on in this administration, just because those are the folks that do so much of the day-to-day implementation of the directives coming from Congress and have to adjust to some of the realities on the ground. So before we launch right to the Farm Bill, I do not pretend to think that that is the only issue facing agriculture, and when we get to Q&A time, you're welcome to ask about additional issues, but things I want to flag just to kind of stir, I guess, thoughts in the back of everyone's head. Immigration obviously is a huge issue, and that's something certainly the Western Slope is not exempt from, those difficulties. Trade, a lot of uncertainty around trade right now, tax reform, infrastructure, all that kind of stuff. So that's something also to kind of have in the back of your head. In the Senate, we have 52 Republicans, 48 Democrats. What that means essentially is that nothing's going to move without bipartisan cooperation in the Senate. I put the Farm Bill into that same category.